one of our resources we have available. This is Mr. Peter Souza with Litman Gregory. Peter has an investment background. He's worked with iShares Group, BlackRock, Credit Suisse. He has a master's degree in financial analysis and investment management. He is one of our resources that we can reach out to when we have questions about the markets or possibly how Litman Gregory is positioned at this time. As most of you know, Litman Gregory's probably my top manager on the advisory platform. Had a really good relationship. I think their research is exceptional. They really understand what they own, why they own it, and sometimes they're maybe a little contrarian and owning things that might be a little bit out of favor, but that's what institutional investors do. They have the discipline to buy when you and I might be emotional and want to sell. So I'm going to turn it over to Peter.
Thank you so much, Mark, for the introduction. I really appreciate that. And I think that Mark did a great job of highlighting one of the philosophies of our investment process, and that is to be very patient and to really have the courage of our convictions, to understand that we are long-term investors. So I want to thank Mark very much for asking us to be on this call today. We always appreciate the opportunity to speak directly with our clients. So in terms of what I'd like to cover today, I'd like to provide just a brief overview and background on Litman Gregory as a firm, talk a little bit about some of what we felt drove performance during the second quarter, and then finish up with how our portfolios are currently positioned. So as Mark mentioned, my name is Peter Souza, and I'm the Research Product Manager with Litman Gregory. Essentially, my role is to provide service and support to advisors such as Mark. I also have a role on the research team here. So with that, just to provide you a little brief background on Litman Gregory. We are what is known as a boutique asset management firm. Our offices are located in Northern California, just outside of San Francisco. Our model portfolios have been available on the Genworth platform going back to 1996, and we've actually been managing money for our own clients going back to 1987. So this slide provides a summary of our investment process. And really pursuing returns and managing risks, we feel really starts with the foundation of a very well-defined investment process. And as I mentioned, this slide provides a very simple summary of how we manage our portfolios. So to summarize, we really strive to add value in two ways. The first is via the tactical changes to the portfolio's asset allocation in response to changing risk-reward opportunities and market conditions. And the second is via our active manager outperformance versus their underlying benchmarks. So just to provide a brief overview of what happened in the second quarter, and really after a fairly smooth start to the year, what we saw is volatility return to the markets in May and June on the heels of Federal Reserve statements that led the market to conclude that the quantitative easing program may be coming to an end sooner than expected. Markets reacted very sharply. U.S. stocks suffered steep short-term drops, falling nearly 6% peak to trough before recovering to post one of the quarter's very few positive performance. As Treasury yields spiked, bond prices posted their second quarterly loss for 2013, the first time since the second half of 2008 that bonds have posted two consecutive negative quarters. So my review of the second quarter will really focus on two market developments that were noteworthy at both a broad macro level and because of how our portfolios are currently positioned. Both of these developments had, to varying degrees, the same underlying driver, comments from the Federal Reserve about the future course of monetary policy. So the first development that I'd like to address was the spike in interest rates that we experienced during the second quarter and how it impacted our portfolios. So at the beginning of May, the 10-year Treasury yield hit a low for the year of 1.63%. Yields then rose steadily before spiking to around 2.6% at the end of June, its highest level since August 2011. The spike in rates were driven by comments from the Federal Reserve indicating that they might begin to slow the pace of their monthly bond purchases sooner than had been expected, given improving economic fundamentals. So bond prices have an inverse relationship to interest rates. As interest rates rise, bond prices fall, and vice versa. So the rise in interest rates resulted in significant capital losses for bond investors, reaching into the double digits for long-term treasuries and the low to mid-single digits for the aggregate core bond index. As a result, in June, we saw all-time record outflows of around $80 billion from bond mutual funds and ETFs. So in terms of how this spike in interest rates impacted our portfolios, for several years, we've positioned our fixed income allocation for what we expect to be a longer-term trend of rising interest rates. We've been tactically underweight to core bonds, and core bonds are investments such as U.S. Treasuries and U.S. investment-grade bonds, and these investments have a high degree of sensitivity to interest rates. We've chosen to focus our exposure using flexible and absolute return-oriented fixed income funds that we believe can do well in a rising interest rate environment. These types of bond funds have much wider latitude to change their portfolio characteristics to account for rising interest rates, as well as they have the ability to invest in areas of the bond market that offer more attractive risk-reward profiles than what we could get if we were to invest in either U.S. Treasuries or U.S. investment-grade bonds. And the second major development that I want to focus on is the sharp decline in emerging market stocks and bonds that occurred during the second quarter. So this slide reflects the performance of the emerging market stocks index really going back to 2008. But what we want to focus on here is from their highs in early May through their lows in late June, emerging market stocks lost around 15%. In comparison, U.S. stocks fell just over 2.5% over that period. Investors seem to be getting more optimistic about the U.S. economic recovery, which lended additional support to U.S. stocks. So really, just to break it down from a high-level point of view, it was really, what we would consider a tale of two quarters. Before the performance that we experienced before the Fed announced that they might be tapering their monthly bond purchases, and then the performance that we saw afterwards. And this chart really puts into context the extreme reactivity that we've seen over the past few years, given how active our Fed and global central banks in general have been in trying to moderate the economic effects of the financial crisis. We believe that the market is currently pricing in too rosy of an outlook, particularly as you take into account slowing profit growth and slowing global growth over the next 5 years. So in our base case scenario, we view the return potential for U.S. stocks as being extremely low over the next 5 years. So now we're just going to talk about our longer-term outlook and how our portfolios are really currently positioned. And so what this chart shows is the current economic recovery relative to what we've experienced over the past 6 recoveries following a recession. And as you can see, U.S. economic growth has been abnormally low relative to past recoveries, and that the global economy remains extremely fragile. The problem is that it's nearly impossible to grow your way out of debt in a very slow growth environment. Basically, in our view, our long-term outlook remains the same. We think that we're in a very slow growth environment, and we don't believe that the market is pricing in the potential for some of these bigger picture macro risks to come back into play at some point in the future. So with regard really to one of the highest priorities for our clients, and that is risk management, we want to note that these risks are all interrelated and they're extremely difficult to predict. So this slide represents the 4 broad macroeconomic scenarios that we're currently considering in our portfolio management process. And again, our base case scenario continues to be that of a subpar economic recovery. So this slide, we can just talk through this real quickly. This just represents how our portfolios are currently positioned. And I think what we're trying to do in terms of our portfolio positions is really to make sure that we're being compensated enough in terms of future return potential for the risk that we're taking on in each of these specific asset classes. So just running down the list, investment-grade bonds, this is what I referred to earlier as our core bond allocation. As you can see, we're very heavily underweight to investment-grade bond types of exposure. And the reason for that is that in a very low-yield environment, the ability for core investment-grade bonds to generate decent returns is significantly diminished. As I mentioned earlier, we're underweight stocks by anywhere from 10 to 12% in our balanced portfolios, and the majority of that underweight has been taken directly from our U.S. equity allocation. And the reason is that we just feel that the U.S. equity market is overvalued. We don't believe that it's pricing in the slower growth environment that we believe we are in. So essentially, as the U.S. stock market has continued to rally, we've consistently taken some risk off the table because we feel that we're not being compensated enough in terms of future return potential for the downside risks associated with U.S. stocks. The long-term fundamentals for emerging market stocks are very attractive. We think that they offer much higher growth rates than what we're going to see here in the U.S. In addition to that, in terms of how we look at the potential returns from stocks, emerging market stocks are trading very cheap relative to what you would pay for U.S. stocks at this time, and we think that really bodes well for the long-term return potential of emerging market stocks, both in absolute terms and relative to what we think we can achieve by investing in U.S. stocks over the next 5 years. So really just to summarize, we think that the investment environment will continue to be challenging for the foreseeable future. We really feel that in this type of environment, it's very important to have a focus on preservation of capital rather than trying to knock the cover off the ball and really trying to generate outsized returns in a very uncertain environment.